Hey, wealth tubers, let me take you back to a moment that could shake up your finances in a big way. Just a few days ago, the Federal Reserve made a move that's going to change how much we pay for loans, credit cards, and even how much we save. They cut interest rates for the first time since 2020. Now, I know interest rates might sound like some boring economic stuff, but trust me, this decision affects you. Whether you've got debt, a mortgage, or you're just trying to make the most of your savings, this shift could either lighten the load on your wallet or shrink your savings returns. So, what does it all mean? Stick around, and let me break down how this rate cut could open new doors for borrowing, help you get ahead on debt, and maybe even boost your job prospects. Let's dive into the story of how this Fed decision could change the game for all of us. Picture this. As you're going about your usual routine, the headlines start flashing. The Federal Reserve has made a monumental move. For the first time since 2020, they cut interest rates, dropping the influential federal funds rate by 50 basis points to a new range of 4.75% to 5%. For over a year, the Fed had been holding those rates steady at a higher range, 5.25% to 5.5%. all in a bid to cool down the fiery inflation that kicked off in 2021. Remember those days? Groceries were getting pricier, gas was through the roof, and borrowing money became more expensive every month. But now, it seems like a shift is in the air. The Fed has officially changed direction, signaling that the long battle against inflation with rate hikes could be coming to an end. And this cut? It's not just a small adjustment. It has major, real-world effects on your wallet. Let's break down what this means for your money, your plans, and how you can take advantage of this big change.
The domino effect of a Fed rate cut.
To really understand how this impacts you, let's take a closer look at how the federal funds rate works. The federal funds rate is like the heartbeat of the financial system. It's the rate that banks use to lend money to each other overnight. When the Fed cuts that rate, it's like a ripple effect. Banks start paying less to borrow, and those lower costs are passed on to consumers like you. This means that the cost of borrowing money, from mortgages and car loans to credit cards and personal loans, could start to drop. But that's not all. This shift is a signal that the Fed is stepping back from its aggressive fight against inflation, which could have deeper implications for the economy as a whole. So, how will this play out in your daily life? Let's take a closer look.
Debt just got a little lighter.
If you've been feeling the squeeze of rising interest rates over the past couple of years, you're not alone. Mortgages, car loans, and credit card interest rates all shot up as the Fed raised rates to cool down inflation. But now, with this rate cut, the weight of that debt may start to feel a bit lighter. Take mortgages, for example. In anticipation of this rate cut, mortgage rates have already started to dip. Now that the cut is official, many financial experts believe that mortgage rates will continue to slide down. If you've been thinking about refinancing your home loan, now could be the perfect time to lock in a lower rate. But perhaps one of the most immediate impacts will be on credit cards. Over the last 2 years, credit card interest rates have climbed by an average of 7 percentage points, putting a serious strain on anyone carrying a balance. If that's you, this rate cut could bring some relief. Once the Fed's decision trickles down, your credit card interest rates could start to fall, though it won't happen overnight.
Hiring could get a boost.
Now let's shift gears to something bigger, the job market. High interest rates over the past year haven't just affected consumers. They've also put a damper on business growth. As borrowing became more expensive for companies, many businesses decided to slow down hiring or even pause expansion plans altogether. Just look at the latest data from the U.S. Department of Labor. In August, the economy added 142,000 jobs, short of the 161,000 that economists had predicted. While it's still positive growth, the pace has been sluggish, and the unemployment rate even ticked up, triggering concerns about a possible recession. This is where the Fed's rate cut comes in. Lower interest rates make borrowing cheaper for businesses, and that could lead to a resurgence in hiring. Employers who have been hesitant to expand might now feel more confident in borrowing money to grow their teams. In other words, this rate cut could provide a much-needed boost to the job market. It won't be instant, but over the coming months, we may start to see an uptick in job openings, giving more people a chance to re-enter the workforce or find new opportunities.
Savers might feel the pinch.
Of course, not every part of this story is rosy. While lower rates mean cheaper borrowing, they also mean smaller returns for savers. Over the past year, anyone with a high-yield savings account or a CD, certificate of deposit, has been enjoying some pretty nice interest rates. At one point, 6-month CDs were offering rates as high as 6%, giving savers a solid return on their money. But now that the Fed is shifting gears, those rates are likely to drop. This doesn't mean you'll go back to earning practically nothing on your savings. Rates won't fall to pre-inflation levels, but you can expect your returns to shrink over time. If you've been relying on those higher interest rates to grow your savings, this might be a good time to review your strategy. Some experts suggest looking at alternatives, like exploring longer-term investments or finding creative ways to make your money work harder in this new, lower-rate environment.
The big picture. What's next for you?
This interest rate cut is more than just a financial footnote. It's a major turning point for the economy and for your personal finances. Whether you're paying off debt, thinking about a major purchase, or just watching your savings account, this decision by the Federal Reserve will likely affect you in one way or another. The best thing you can do? Stay informed. Keep an eye on interest rates for mortgages, car loans, and credit cards, and don't hesitate to explore new options that might help you save money. At the same time, if you've been benefiting from high savings rates, it might be time to reassess your game plan. This rate cut isn't just numbers on a page. It's the start of a new chapter in your financial journey. Imagine the weight of your debt lifting, the relief of paying less in interest, or the excitement of finally seizing that opportunity you've been waiting for. But it's not just about the money. It's about your peace of mind, your future, and the chance to take control. The Federal Reserve may have set the stage, but how this story unfolds depends on you. And there you have it, Wealth Tubers. The Federal Reserve's rate cut isn't just a headline. It's a ripple that's going to flow through our economy and right into our daily lives. Whether it's making your debt feel a little lighter, helping you lock in a better mortgage rate, or even impacting your savings account, this decision touches us all in different ways. But remember, just like any story, how you respond to this moment is what truly shapes the ending. Are you going to jump on the opportunity to refinance, consolidate your debt, or find ways to invest smarter? Now's your chance. The Fed's shift is opening new doors, so make sure you're ready to step through them. If you found this helpful, hit that like button, share your thoughts in the comments, and don't forget to subscribe for more insights that'll help you stay on top of your financial game. Until next time, let's keep building that wealth